I posted this just after 9 a.m. I said, add a little bit more to my Tesla market hedge, right? Tesla's a perfect hedge on the stock market. And I just showed you why. Stock market goes down a bunch, Tesla goes down dramatically more. So if I'm worried about, oh boy, this market might be frothy, we might be topping sometime soon here, it makes sense to hedge against something like Tesla. So what I went ahead and did, I added more this morning to my Tesla hedge position, TSLZ here. I'm up to 44,444 shares. That's about a $32,000 position here. And here's how the math works around this based upon my estimates, okay? This is how it works, and this is why this is so compelling to me, okay? Let's say, hypothetically, NASDAQ goes through a little bit of a tough time short-term meaning the next 2 months, okay? And the NASDAQ goes down 10%. Not a crazy number. That's not a 2022 where the NASDAQ goes down 30+%. That's not a great financial crisis where the NASDAQ goes down to 50%. That's not a tech bubble when the NASDAQ went down 70%. Just 10%. Just a nice little pullback. 10% down. In that market, I would say Tesla's down at least 25%, right? It's usually going to do 2x or 3x, whatever the NASDAQ's doing on the upside or downside. If you get a 25% down move in Tesla, I'm 2x leveraged against Tesla. That's going to be like a 50% move, roughly, somewhere in their ballpark in regards to this, right? So I'll get like 50%-ish appreciation. So that $31,000 then grows to $47,000. And once again, that's off of only a 10% NASDAQ move down. Now imagine if it's 15%, 20% down for the NASDAQ. Now you can begin to understand why this is an appropriate hedge against the market. People are like, why would you hedge with Tesla if you're worried about the market in general? This is why. I hope everybody understands this now, right? I spend all day like focusing on this stuff, right? I like trying to figure out the best way to do these things. All I do is think about this stuff, right? And so I'm always trying to think like, okay, should I play put options? Okay, what if the market doesn't go down between those put options expiring? Do I want to bet against the market in general? Bet against the market in general, okay. Like I could do that. And okay, the NASDAQ goes down 10% and I make 10%. But why would I want to just make 10% when I can make 50%, right? That's the way I like to think about this game. And I do my hedges small. Because at the end of the day, like if you do your hedges right, you know, they can appreciate in a great deal. And next thing you know, you're in a situation where, you know, a small amount of money can turn into a much bigger amount of money. And believe me, there's a lot of stocks I love right now. And if the stock market goes down 10%, NASDAQ goes down 10%, there's going to be stocks I want even more. And then I'm sitting on about $50,000 hedge here. And I could put that money right into long positions, right? That's just covered my bases. Now, I also have another hedge in the public account as well. This one, PLTZ. This is 2x leverage against Palantir stock. This one scares me. Tesla does not scare me because Tesla has no fundamentals, right? So it's just on hype. And if the market's risk on, people want to own Tesla. If the market goes risk off, people dump Tesla, right? But Palantir, this one scares me a little bit because this one, here's the deal, okay? If Palantir comes in this next quarter and they report revenue growth in the mid 50s or above, Palantir is going 200. 200, ladies and gentlemen. That's what scares me around Palantir. So this is basically a bank that we get some market weakness. And additionally, Palantir reports, let's call it 50% or less revenue growth in our next quarter. And if they do that, then we could talk about the potential for Palantir to go down quite a bit, right? Which would then, these put options would appreciate, or not put options, this hedge would appreciate in a great deal, right? This ETF here. But the risk is, like, you know, like I said, like that stock's going 200 if they come in with a mid 50s or above revenue growth. Everybody will flip their flapjacks. Now, with that being said, it's not a good buy right now, and it's not a good buy at 200. Even if they come in and report 55% revenue growth next quarter or 58%. It might be a good buy for the very, very short term, but I can tell you that's not a good long-term buy. That valuation is so out of control. Palantir's priced in like 7 years of growth. Like at least 5 years of growth now they priced in, but they might be pricing in like 7 years of growth. It's ridiculous, okay? So just understand, you got to differentiate between what's going on short term with Palantir and what's going on long term. Palantir's priced in so much that stock, it's not a buy regardless. But with that being said, the stock could go to 200 short term if they come in with a mid-50s revenue growth or above. Now, I posted this. This was on my X page. Once again, if you ever want to follow me on X, it's always linked in my description area down there of all my videos, right? I said, I have $1 million on the sideline. What should I buy? And that post ended up getting 180,000 people to view it, and 500 plus people ended up leaving comments on what stocks I should buy and what I should do here, right? And here's how I'm thinking about this subject on a little bit of a higher level, right? Because I'm holding pretty considerable cash levels. If we don't have a market pull down, which I think there's still a good chance we have a market pull down between now and year end, but let's say we don't. Let's say just up, 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 up. I'll build cash. I might exit the year $1.4 million or $1.5 million of cash, right? So now if we have a pull down, like let's say we got that NASDAQ down 10, 15%, now we're talking. Now I'll deploy money in the market and come through with some big buys. The further the market goes down, the heavier I deploy, essentially. The more frothy the market is, the more potentially overvalued the market is, the less I'm incentivized to come in. So time periods recently where I came in and invested heavily was earlier this year when we had the tariff drama back in March and April, came in with big money. Another time would have been 2022. I got so low on cash, it was ridiculous. I was buying everything in sight because it was like the best tech companies in the world were trading at, discounts that you could only have dreamt of. Like that's like once in a generation buying opportunity for tech companies, right? Obviously coming out of the Rona crash, buying very, very heavily in regards to that matter. And then the end of 2018. Then in 2018, we had the S&P 500 go down like 20%. NASDAQ go down like 24, 25%. Quick amount of time. October, November, December got ugly for the market, which is potential that could happen this year. And I came through and, I got very, very low in cash. Like I think I got down to like $10,000 of cash in that 2018 timeframe. It got low. And if that market didn't bottom there at the end of 2018, like I didn't really have money left to buy. Like if that market just kept going down, I was done for. Done for in the respect of like, I didn't have like a bunch of cash to continue to buy essentially. So I got the timing right, thank goodness. Now, if you look at forward P on the stock market, this is basically my entire investing lifetime. I got in the market back in 2008, right? And then got more serious as the years went on. So if you look, basically these two time periods are irrelevant to the forward P of the S&P 500. And the reason being is both of these time periods, the earnings of all companies that were in the S&P 500 tanked massively, right? This was in the great financial crisis. Everybody's earnings tanked during that. It was, biggest recession we've seen in a long, long time. Unemployment rates around 10%. And then right here, same exact phenomenon. This was in early 2020 because of the Rona crash, the shutdowns that hurt companies' earnings dramatically, right? So forward Ps looked ridiculously high right here, and forward Ps looked ridiculously high right here. So you got it. That's the only time it ever makes sense to buy the market with forward Ps that are ridiculously high is when you're in the middle of a massive recession, and that's it. Okay. So you want to look at like normal economic times, like what we're in right now, right? And there's no doubt, like very recently here, forward P has gotten very elevated. So it's not a great time to be a buyer of the market in general here over the past, I would say, month or a few months here, right? If you look, every single time we usually come to this sort of point, that forward P ends up dropping considerably, right? Like look at, we were right here and we got that massive drop. We were right here, very similar, massive drop, right? And then right here, you also got elevated, massive drop over the years. So forward P gets elevated, just understand it doesn't make sense to be buying heavy in that sort of market, especially if you're a long-term investor. You're not getting great deals. You're not getting great pricing. When the forward Ps are low, you're getting great pricing. Or if you're in a massive, colossal recession, high forward Ps is actually a good thing in that sort of environment, right? No, you got to understand, just because I'm not coming in with the big money right now, right? I'm not coming in with the rocket launcher. You got to understand, I'm still buying thousands of dollars of stocks every Friday. Every Friday, I'm buying in the public account. I'm buying in my Patreon portfolio. I'm buying in my private portfolios every single Friday with thousands of dollars. So yeah, I'm not coming in with the big money, but I'm still out there buying. Regardless of the market, I always look at it as I've got to find great deals in the market. I got to find exciting investment opportunities with low risk and high reward, regardless of the market. I don't care if the forward P is 23 on the market like it is right now. I don't care if the forward P on the market's 18, 16, 14, 25. Doesn't matter. I've got to find great investment opportunities. That does not mean I got to come in with all my cash and just go all in the market all the time. But it does mean I got to always consistently buy week in and week out, right? And then when I want to come in with the big dog money, we'll come in with the big dog money when there's drama. And there's always drama. Like it never fails. It never fails. You always get something. You always end up getting something. And next thing you know, market's down big because of blah, blah, blah reason, right? Where people get in trouble is they get in this game of like, I'm going to sell out of my portfolio. I'm going to sell out all my stocks. Then I'm going to hop back in the market. And that's going to, no, it doesn't work like that. I know. Like everybody always thinks they're much more intelligent than they are, right? No, it's not happening. It's not happening. It's going to end up producing you far worse results over time, right? Even if you can time that one, you're going to try it again, and then you're going to get screwed. And that's going to be the one that you're like, oh my gosh, I got my timing wrong, right? And you're in a whole situation in regards to that. Now, if you wanted some more context on stocks I'm specifically interested in right now and things like that, I've created some videos recently. This video right here, 3 grade A stocks you must buy. The moves could be extreme in 2026. I put that video out 6 days ago. It's got 116,000 people have watched it so far. That's like 2 Raider stadiums worth of folks. That one you may want to check out, right? That definitely covers that. Also, I have this video I produced 2 weeks ago. It has 212,000 people have watched that so far. 4 Raider Stadium full of folks, right? 7 stocks to buy now, October 2025 edition. Talk about some of the best investment opportunities I could find in the market right now. This is my best video of 2025 right here, how to make $100,000 plus a year from stocks in 6 steps. That video is straight gem dropper. That's one of those videos, don't ever let it die, man. That's one of those videos got to live on for a long, long time, okay? Now, I'm building a house right now, right? When it's raining out, do they stop building the house? When it's windy, do they stop building the house? When it's really hot out, do they stop building the house? No, of course not. They keep building and they keep building regardless of whatever the weather is out. They don't need it to be perfectly 80 degrees and sunny to build the house, right? They keep it moving. The same way you would think about building a house, the same way you got to think about building a portfolio. We're going to go through time periods of rain, wind, storms. It's going to be ugly, right? And we might even be going through that, over this next bit of time. You don't stop building the house. You keep on building and building and building. And that's what I've been doing the last 17 years. And as long as I'm here, my plan is to continue to build and build and build the house, right? And the rest will be what the rest is going to be. You got to remember all these short-term time periods we go through. If we get a 10%, 15%, 30%, 50% pullback in the market, correction, crash, blah, 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 it'll all just be like a blip on the radar, right? No different than the great financial crisis was, no different than the tech bubble pop was, no different than 2022 was, no different than 2020 was, no different than 2018 was, right? It all ends up just being a blip on the radar. It was just like, at the moment, it felt like, oh my gosh, this is insane. But then you look back 5, 10, 15, 20, 30 years later, and you're like, that was nothing. Yeah, it was drama for that 1 to 2 years, or that 6-month span, or 3-month span, or whatever, but it was nothing in the end, right? I mean, you look at even the tech bubble pop there. I mean, look at the NASDAQ now. Where's the NASDAQ today? 20,000 or something like that, right? The NASDAQ was peaking around that 4,000 to 5,000 range, and it fell all the way down to 1,000 something, right? I mean, the NASDAQ was still a great buy at 4,000. It was an even better buy at 1,000, right? So, it is what it is, and just keep building, man.
Hey, I want to thank you so much for watching that clip. I hope you really enjoyed it. What I'm showing you in front of your face right now is 1000xstocks.com. This is such an important website and service to use if you want to research companies, if you want to understand companies on a high level, so you can hopefully get better results in the market. And we know as the years tick on, money compounds. It is so important you research companies, you compare companies, you're listening to conference calls, looking at SEC filings, all that's included into 1000xstocks.com. So to enjoy 1000xstocks.com and to apply for that service, you can go to the description area of this video, or you can go to 1000xstocks.com, whichever you prefer.
So I did a poll on my X page. My X page is always linked in the description if you guys want to follow me on X, okay? Post a lot of stuff on there almost on a daily basis, okay? And I did a poll last night. Over 4,000 people voted on this poll. I said, will the market be red or green this week? I mean, it was overwhelming. People voted green. Like almost 70% voted the market's going to be green this week, right? So retail remains bullish on the market overall. Definitely remains bullish. Then, I showed something like this, right? And this was, woo! So this shows you 1987. Worst day to talk about in the stock market history, S&P 500 down 20%. Why can we not get that nowadays? Why can't we have the stock market go down 20+% in a day, right? You understand it's so hard to scare people nowadays in regards to investors in the market. So hard, So hard. Let me give you an example of how incredibly difficult it is to really cause panic in the stock market nowadays, okay? This was in the Rona crash. Keep in mind, let me take you back to March of 2020, right? There was talk about the worldwide economy is going to be closed for 3 years. There's talk that even the strongest companies are going to go bankrupt. There was talk about we're going to have a depression, an economic depression in this country, much more severe than the Great Depression. Bread lines, soup lines, like on steroids. There was talk that, this was going to make the great financial crisis look like a little something, right? With that much insane fear out there, and by the way, that was justified fear. That was real talk. Like we're going to shut down the global economy for 3 years. How can you make it through that? How can any company make it through that, right? Like shut down the global economy, like shut down travel, everything for 3 years. There was real fear. It wasn't like that was just, And yet, what happened? The S&P 500 had its fastest stock market crash ever. Went down 34%. 34%? And we were talking about this was going to be the Great Depression, but way worse. And all we got was 34% decline. The market should have been down 60, 70, 80%. Like easily 60, 70, 80%. And all we had was a 34% drop we had to show for it, which is severe, but not considering how insane that situation was when you were in it at that particular time, right? Like we didn't even know like how deadly it was. Like people thought like, holy smokes, like people were assuming like we were going to lose a massive percentage of the population potentially. Not just in the United States, but around the world. And yet, that's all you had to show for it, 34% decline and then right back up. Then we had 2022. S&P 500 goes down 25%. Big down move from the peak of the fourth quarter of 2021 to the bottom of the fourth quarter of 2022, right? 25% down in the S&P 500. But it wasn't that crazy when you think about we had out of control inflation, like the most out of control inflation we'd seen since the 1980s, right? We had the Fed raising rates at the fastest clip on a percentage basis we've ever seen. And we had Russia-Ukraine start. With those three severe things all happening simultaneously, you would have thought, and coming off of a super out of control bullish market and the stimulus and everything like that, you would have thought we would have got more than a 25% down move. But that's all it ended up being, 25%, and then we went straight back up, right? You've got to understand what happened in 2008 has changed everything forever. The government used to not be in this like bailout mode. The Federal Reserve used to not be in this like bailout mode. But once 2008 happened, because it was so severe, and we're talking about almost the entire banking system collapsed essentially in the United States of America, and much of it did, right? That changed everything forever. Because then the government and the Federal Reserve realized we can basically backstop this, right? So they did TARP and they did all these other actions, quantitative easing and lowered interest rates down to nothing and all these things that people thought would never happen, and they did it, right? And that changed everything forever. Because from that moment on, now anytime something crazy happens, the government's ready to step in, the Federal Reserve's ready to step in, do whatever it takes to rescue the market. And we had a great test of this. So anybody that thought like maybe they're not going to do that anymore, 2020 was a great test of this. Obviously, everything starts shutting down. Oh my gosh, it's the end of the world, right? And what happens? The Federal Reserve backstops everything. They take interest rates down to zero. They do quantitative, unlimited quantitative easing. The government starts sending out stimulus checks, right? They're like, oh, if you don't want to pay your rent, you don't have to pay your rent. We'll backstop that. Like that was a whole situation. And that was proof that everything changed forever, which is why it's so hard to get, I would say it's very, very difficult since 2008 to really get those severe crashes now at this point in time, right? Now, additionally, people understand the math in regards to this better than ever, right? The stats are all out there. You can access them anytime you want. In regards to the situation, if you look, the S&P 500 has logged corrections, a decline of 10% or more 56 times since 1929, right? Only 22 of those times, the market went into actually a bear market. The majority of the time, when you get a 10% decline, you're not going into a bear market. 34 of those times, it did not go in a bear market. So even if you get a 10% decline, the overwhelming majority is we're not actually going to go into a bear market in this situation, which makes investors say, I don't really need to be that fearful of this whole situation, right? Fascinating. Now, this does make the market more volatile. If you look at the stock market the past 30 years, it is more volatile, right? But here's where the exciting part comes in to everybody watching this video right now. Okay, listen. A more volatile stock market, you might think that's scarier. Listen, a more volatile stock market means there's way more money to be made. It's going to mean you're going to get more of these pullbacks, corrections randomly, right? And then snapback rallies, which means there's going to be more money to be made. If you know how to invest properly, there's more money to be made than ever before. Because if you know when to position into calls or puts, that's a tremendous opportunity, right? But you don't have to take it all there. You can just be a long-term investor, and you know when to, okay, market's getting a little frothy, forward P's are high, let me start cashing up a little bit. My stocks, this stock aren't going to produce me that great of CAGRs in the next few years. Let's take a little profit, so you build your cash balance up, right? Then you get that volatility in the market. Something happens, something breaks, somebody gets scared. Boom, all of a sudden, next thing you know, 10, 20% down in the market quick. And you're able to then get stocks. You got to understand, for individual stocks, you get the market down 15%. This is going to be counting as growth stocks down 30 to 50% on a 15% decline in the S&P 500. Volatility spikes massively. You're able then to come in, step in, buy those stocks, and the recovery of those stocks can be severe on the other side as well, right? Where they just blast off. That's exactly what we saw in 2022. A lot of people didn't think, when Meta went under 100, when you had Palantir down to $6, when you had Shopify down to 25, when you had Netflix down to $170, right? By the way, Netflix is like $1,200 now. When you had all that happening, people thought like these stocks they're going to take a long time to recover like this, right? It was suddenly like a year later, and a lot of these stocks had already recovered to near previous levels. And now you look at them and like, oh my gosh, like they're up dramatically. A lot of them have 4x, 5x, 6x, 10x. Look at Nvidia, for instance, right? AMD was $55 in that 2022 crash at the lows, right? AMD's pushing close to $250 now. I mean, my gosh, like think about that for a moment. So understand the fact that the market's more volatile, it actually produces a much better probabilities of you making life-changing money in the stock market if you know the way to play this game on a high level, right? Now, additionally, another reason it's hard to get the market down, it has to do with margin, right? Because you would look at the market and be like, okay, it's trading rich right now. Who's to say retail's not going to come in, or whoever's going to come in and actually start margining out things, right? Which sends the market up even higher, right? Now, we know eventually that comes crashing down. You get a deleveraging of the stock market, right? Stock market goes down a bunch. You get a bunch of margin calls on folks, and the people that are on margin that were partying eventually get hammered hard. That's why you don't want to mess with margin. That's why I don't want to mess with margin. But you got to understand, like, there's a lot of people in a time period like we're in that have been playing margin. There's no debating that, right? Which just sends the market higher and higher, and a lot of these stocks higher and higher. And eventually, they have to pay the price for that. But you never know when the price is going to be paid. Like, that could be paid a month from now. That could be paid a week from now. That could be paid a year from now. At some point, there's going to be a price to pay for all that margin, but we don't know exactly when that is, right? And between that time and this time, like, who knows what can happen with the market? It could go up dramatically. You don't know, right? Additionally, I saw this on CNBC here today. I had to take a picture of this for you guys. They had a typo here. They said 2015, but it's supposed to say 2025. But now retail investors make up over 20% of the trading volume on a daily basis, right? And then high-frequency funds, also significant. So high-frequency funds, like, they're not even really looking at the macroeconomic picture or government shutdowns or things like that, right? So that definitely changes the market dynamic. It's changed forever in a monumental way, right? And I don't see that changing. I mean, retail is going to be a huge component of the market, even probably bigger and bigger for, I would say, the next 10, 20, 30 years, right? Now, additionally, why is it hard to get the market down? Look at this. Look at this, ladies and gentlemen. This $7 trillion plus chilling on the sideline. And this is, I mean, at the end of the day, you get a drop in the market and there's just always money to buy it because there's so much money sitting over there in T-bills right now, sitting over there in savings accounts, checking accounts, all that sort of stuff, right? Just sitting around. Even myself, for example, I have over $1 million of cash right now. I don't mean literally cash. I just mean money in either savings accounts, CD accounts, treasuries, things like that, right? Just sitting over $1 million. I was talking with a friend this weekend. He said he has over $5 million. Over $5 million just sitting around right now. He can't wait for a crash. He's like, I can't wait. And he's not the only one. I know a lot of people that have a ton of money in treasuries, savings accounts, CDs, that are just waiting. They're like, can this market crash? Because they just want to buy in so bad. Some of them, it's like they just want the S&P 500 to go down 20%. Some it's 10%. Some they want a 30% plus drop. But the issue is, it gets tough to get that 30% drop in the S&P 500 because you got a bunch of dudes loaded up on cash that even if you get a 10% drop, they're ready to come in. And you got other dudes out there that are ready to jump in at a 5% correction. You got other dudes that are out there that are 2% correction, like, I'm ready to funnel money in this market. And that's another reason it's hard to get this market down, even with a lot of bad news and worries about this and worries about that, because there's just a disgusting amount of money that is just waiting to buy every dip in sight, right? Now, additionally, one of the biggest money sucks out of the stock market over time is real estate. Like, there's no debating that, right? Like, think of a high net worth individual. High net worth individuals, what do they do a lot of times? They will buy homes cash. They won't even take out a loan on it. So, somebody that has a $50 million net worth, they want to buy that $7 million house over there, they'll go buy cash. And a lot of times they'll sell stocks, or they could take it out of treasuries or CD accounts, things like that. But a lot of times they'll sell stocks. They might have a significant portion of the S&P 500. So they say, okay, I'm going to take, $10 million sale here, right? Pay my taxes on that. Now I have $7 million ready to go ahead and invest that into this house, right? And just own it outright. Additionally, regular folks, average folks, also have a similar phenomenon, but they won't buy a house cash, but they will put down their 5%, 10%, 20%. 20% is pretty customary. And where does that money come from a lot of times for folks? It comes from the stock market. They might have money invested in the S&P 500 index fund, or they haven't invested in individual stocks, and maybe they have, $700,000 invested, but they need $150,000 for a down payment on that house to meet their 20%. So they go ahead and sell out of $150,000 in stocks. But we don't have any of that going on in the market right now because no one's buying real estate. Real estate market is dead. And it's not like it just went dead. It's been dead for years now. It's been dead ever since 2023, right? It started to die in 2022, but 2023, 2024, 2025, it's been completely dead. Like, ridiculous. Like, the numbers have been worse than at the trough of the Rona crash. Like, that's how insane this is, right? So it's been dead for years. No one's spending on real estate. So where's money have to go? Well, it goes into T-bills, or it goes into savings accounts, or it goes in where? The stock market. Usually money you would put into real estate, you put in the stock market, right? And that leads me to myself and my situation. I say, I either really genius or really dumb. I'm building a house right now. Overlooking the whole city. And we'll see. That house is going to be done in 2026 at some point in time. But I like to look at assets when no one's looking at assets. And something I think is interesting is no one's paid attention to real estate for years now. Years, right? And so I got a house that'll be built next year, right? And we'll see, where that appreciates or depreciates or stagnates over the next 5 years after that. We'll see what happens to that home's value 2026 to 2031. We'll see. But I like to look at assets when no one's looking at assets, right?